Today, we're gonna chat about the most commonly used mortgage terms. We're gonna try and understand the lingo. Hey everyone, my name is Moaeez Rehman. You may call me Mo if it's easier. I am not a mortgage agent. I'm actually a real estate agent. I sell real estate full-time with Remax Impact Realty. And during my time selling real estate, we have helped way more than 100 families buy and sell real estate. Through our time helping our clients, we have really familiarized ourselves with the most common mortgage terms. And today we're gonna share those with you. Let's dive right into it. So this document was provided to us by the folks at 𝐶 Mortgage Group right here in the Durham Region and GTA. We have referred a lot of our clients to them to get their pre-approvals and get their mortgage and refinance and private loans. And these folks are really good, really professional, and really up to date with your technology. So if you would like to get an opinion with these guys, or maybe even get your mortgage or pre-approval from these guys, reach out to me directly and I'll definitely make the introduction. So let's begin with the first term in understanding mortgage lingo, and that is amortization. This is the length of time over which the mortgage will be repaid. So when you get a mortgage nowadays, you'll be provided two options depending on the lender. Either you can get a 25-year amortized mortgage period, or you can get a 30-year amortization for your mortgage. The longer duration mortgage, the 30-year amortization mortgage, will have lower monthly payments, but then you will have to pay your mortgage for an extra 5 years to completely pay it off. 25-year amortization allows you to pay off your mortgage quicker. However, the monthly payments are a little bit higher. The next term that we have here is your mortgage term. This is the length that the mortgage contract, conditions, and interest rate is fixed or applicable for. So when you get your mortgage, once again, you'll have two options. Either you can get a variable rate or you can get a fixed rate. The fixed rate is usually for 3 to 5 years depending on that lender, but during those 5 years, your payments and the interest rate provided to you, they're locked in for that 5 term. After the 5 term, you can refinance or you can port your mortgage. You have other options to you, but during those 5 years, that interest rates and those payments stay exactly where they are. Next up, we have closing cost. So closing cost is a very, very common term. Not only will your mortgage agent go over this with you, but your realtor should also go over this term with you because it's number heavy. And it helps you fully stabilize whether if you are on the right track to having enough funds to be able to purchase a home. Closing costs are in addition to the purchase price of the home, and they are payable on closing day. So if you're purchasing a home for $500,000, of course you have your minimum down payment. Let's say that's $25,000. In addition to that $25,000 down payment, you have something called closing cost, and that could consist of many different items such as your land transfer tax. You will have title insurance, you will have lawyer costs, you could have home inspection as well. A rule of thumb in your calculation is that your closing cost is usually 1 to 1.5% of purchase price on top of your down payment, and those funds should be in your account on closing day, ideally before, but at the latest on closing day. Otherwise, you will not be able to close and you will be in breach of contract. Next up, we have the down payment, and this is the portion of the home price that is not financed by the mortgage loan. It must come from the buyer's own funds or other eligible sources before securing a mortgage. If you purchase a home for $500,000, you don't get a mortgage for the full purchase price. You have to have a portion of it in your down payment. If you have a down payment, you're considered an A-level buyer, and then the bank will give you the mortgage for the remaining amount. Now, when they're talking about your own funds or eligible sources, if you are getting a down payment gifted to you, that is A-okay. There are certain procedures that have to follow for that method, but you can use your funds from your RRSP, or you can also use funds that are gifted to you from other individuals in your family towards your down payment. Next up, we have a term called equity, and this is the difference between the price for which a home could be sold and the total debts registered against it. That's a little language heavy, but let's break it down. Let's presume that you have a home and the mortgage on that home is $500,000. That's your mortgage amount. However, let's say the value of your home is now $1 million. The $500,000 difference right here is considered your equity. So if you ever hear the term, I'm going to take equity out of my home, it's also a strategy that investors often use. That's what they mean. Next up, we have your fixed and variable mortgage interest rate. A fixed rate is a locked in rate that will not increase for the term of your your mortgage. A variable mortgage is an interest rate that can fluctuate based on the changes to the prime rate at the lending institution. Next up, we have high ratio mortgage and conventional. A high ratio mortgage is a mortgage loan higher than 80% of the lending value of the property. A conventional mortgage is a mortgage loan up to a maximum of 80% of the lending value of the property. In summary, what this term means is if you're putting 5% or minimum down payment towards your purchase price, you're getting a high level mortgage. If you have 20% or more, you qualify for the term of conventional mortgage. Next up, we have open and closed mortgage. An open mortgage is a flexible mortgage that allows you to pay your mortgage in part or in full before the end of the term. A closed mortgage, in some cases, cannot be paid off in whole or in part before the end of the term. In other cases, the lender may allow for a partial prepayment of a closed mortgage in the form of an increased mortgage payment or a lump sum payment. So in summary, if you chose, let's say, the 30-year amortization mortgage, depending on the type of mortgage, either open or closed, you may have the option to pay it off earlier, and depending on which type of mortgage you have, if it's a closed mortgage, you may not have the option to pay it off earlier, and you'll have to keep it for the whole duration. In addition to the terms outlined in this home buyer guide, I have put together a few extra terms that are commonly used in mortgage lingo. First off, you have the appraisal. An appraisal is an unbiased professional opinion on the value of the home you intend to purchase by a third party. Oftentimes, when you apply for a mortgage, it is contingent upon the appraisal value coming at or higher than purchase price. Pretty much what the bank wants to do is they want to make sure that you have not overpaid for the property they are going to mortgage. For example, you put a really competitive offer for $500,000 and your offer got accepted, and that now became your purchase price. Now, the bank is not providing you a loan based off of your purchase price. They send an appraisal to ensure the value of the home. And let's presume for now, this is a very rare case by the way, but let's presume that the value actually comes a little bit lower after the appraisal. Let's say the value came at $475,000. Now, this is a difference of $25,000. Now, here is the more notary mention. The bank is only going to provide you financing based off of this value, which came in the appraisal. So the difference of $25,000 right here has to be paid by the purchaser in addition to the down payment cash at hand. So if your down payment was $25,000, you now have to pay the difference of $25,000 in the appraisal to purchase price value. That makes your total down payment go all the way up to $50,000. Now, like I said, this is very, very rare. However, you should be aware of what could happen, because in the event you don't have this $50,000, you may not be able to close and you'll be in a breach of contract and ultimately lose your deposit. Now, we have this conversation with all our clients, and we actually have a way to prevent this from happening. I ensure that you also have a chat with your realtor, if it's not someone from our team, to ensure that you don't fall into the position where you have to pay extra $25,000 out of your pocket. The next term I want to talk to you about that's commonly used in the mortgage field is bridge financing. So a bridge loan is commonly used and provided to you in the event you are selling and purchasing your home, but the closing dates do not line up. In fact, purchase of your home is closing earlier. Let me give you an example. So let's say the sale of your home is closing on September 1st. But the home that you purchased is closing a month earlier on August 1st. Now, for you to be able to close on your new home, you need the funds from the sale of your home, but you may not have that because the closing of your home, the funds that you're receiving, is 30 days later. So for those 30 days, you get something called a bridge loan. And initially what the bank will do is they will give you a bridge loan, the amount of money you need to close on the purchase of your new home, and then you pay it back after September 1st once you have received the money from the closing of the sale of your home. And the final term that I want to chat with you guys about today is a term called HELOC, Home Equity Line of Credit. A HELOC lets you use the equity in your home as security for a credit line, usually at a lower interest rate than a traditional mortgage. It is revolving credit, which means you can borrow the money, pay it back, borrow it again, up to your maximum borrowing limit. So folks, there you have it. These are the most common mortgage terms used during the purchase of your home. Now, my team and I actively sell and represent purchasers in the purchase of their first, second, third, or even investment home on a full-time basis. If you would like to schedule a home buyer consultation with us, completely complimentary via Zoom, because COVID cases are rising up again, so we're trying to keep it as safe as possible, my email written in the description below, and someone from my team, either myself, will get back to you as soon as possible. I'll catch you guys on the other side.